But my next guest says this moment feels to him like the 2008 deleveraging in the housing sector, except who will swoop in now to save the day? Let's bring in Mike Bucella. He's the general partner at BlockTower Capital. Mike, it's good to see you again. Absolutely feels like a rerun. So where do we go from here?
Yeah, it's good to see you as well. So we're experiencing basically a dual-based deleveraging event. So we're experiencing both a macro deleveraging as central banks tighten monetary policy, and we're experiencing a micro deleveraging event within crypto, which I believe, and as you mentioned, very much represents what happened in the housing bubble leading into 2008, where credit standards deteriorated significantly, leverage increased at an unsustainable rate. And it was really a result of this strive-free yield. So you had, as in the mortgage crisis, you had mortgage banks that couldn't compete on rate. So they went down the risk stack to lower quality borrowers. And here we had a similar situation where you had these large-scale platforms, you mentioned Celsius, BlockFi, et cetera, where they needed to sustain user growth, to sustain valuation levels in the market that they were providing in their capital raising rounds. And to do that, they had to offer attractive rates. To then generate net interest margins, which are referred to as NIMs, which is what they're able to generate on their deposits versus what they pay out, they had to go further and further out the risk curve into things that really were not meant for this type of yield environment. So I think very much analogizes well to what happened in the housing crisis. And we're experiencing that, across the board, both macro and micro within crypto.
Yeah, I mean, even the stablecoin thing is a rerun of what happened with the money market funds back in 2008. So we know how that story ended with taxpayer-funded bailouts, some financial firms swooping in to buy others. That we saw lots of that happening. We're starting to see a rerun now. Do you think FTX sort of assumes, because of its deep pockets, that JP Morgan-like role? What happens to firms like yours? What happens to Celsius? What happens to all the rest of it? And it doesn't seem like there's any bailout coming for the people who got hosed here. Well,
okay. So us and others are risk managers. We understand and acknowledge these risks. We manage our portfolios according to that. And so from a private investment standpoint, private investment firm, hedge funds, we manage around this kind of stuff. But for these platforms that are kind of grow at all costs, that's where you experience some of these issues. And really, a lot of it was the off-chain traditional lending that happened in our space that is probably the most worrisome currently and is still being unwound as we speak. Yeah, the bailouts are going to come. This is a distressed scenario. This happens in traditional markets. It's, when you have cash in your balance sheet in these environments, there's a lot of very attractive opportunities. And in these instances, you had, obviously FTX came, and there's a lot of news around who they may bail out or may not bail out, what those structures look like, because when you go beneath the surface, it may look very good for depositors, but not very good for equity holders of these companies. So I think what you're seeing now is sort of a kind of broad-based assessment of markets and kind of figuring out where the bodies lie and trying to assess underlying risk in the markets. But I think generally. Sorry, go ahead.
Well, I was going to say, if you are sort of the sophisticated player in the room and all of this is happening around you, how do you take advantage of a situation so that you can buy something, now? I mean, Citigroup is an interesting analogy. It was trading at rock bottom levels back during the financial crisis, but it's not a whole lot above those levels 15 years later today. So where does BlockTower see the opportunity?
So the opportunity is across the board. There's really interesting parts of the market happening in market neutral strategies where you're seeing spreads blow out. You're seeing the advent of new investment technologies where you can take traditional credit, bring it on chain. But really, it's distress scenarios, and these need to be underwritten at a very, very conservative level. So the world was moving too quickly. Deals were getting done too quickly. Capital is being deployed too quickly, and that culminates in something like we're seeing today. I think it brings it back to being able to have the time to underwrite an investment, the time to structure it well. And if you're in a position, with a strong balance sheet, you can take advantage of these opportunities. I mean, I've talked to, and this is both crypto native, but also traditional asset managers. I mean, name the largest credit funds, the largest asset managers in the world. I've spoken with most of their special situations heads. They're all looking at this market. They're all trying to figure out exactly where they can deploy their balance sheet, where they can take their traditional structuring and apply it to our space. And we're working alongside them to figure that out as well. We want our industry to come out of this stronger. We think it will. This is an 18 market cycle all over again from a peak to trough scenario, actually not as bad as 18. Yeah. The only difference is we don't have an accommodative Fed and a macro environment that is a bit more strong than it was back then.